Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here's what we're paying attention to in the markets right now. First, no matter where you look on the U.S. Treasury curve, yields are back above 4% across the board. After a drop to around a 3.5% yield for the 2-year and 10-year Treasury notes in September, rates are trending higher as the market is realizing inflation is likely to stay more sticky than expected. This puts the Federal Reserve in a tight spot since they don't want to cut the Fed funds rate by too much and reignite inflation. The good news for balanced investors is a 4 to 4.5% risk-free annual return is still available to protect one's purchasing power. The first half of 2024 was defined by the Magnificent Seven tech stocks. The second half of this year has been a different story. More than half of the S&P 500 return in the first 6 months of this year was driven by 7 mega-cap tech companies. But since July, the index return is coming from a much broader assortment of companies and sectors. This is good news for diversified investors. The problem is, with seemingly all sectors now performing well, a lot of good news is now baked into current prices. This is a simple chart that compares the trajectory of the S&P 500 with the estimate of earnings per share for the companies in the index. They tend to move together, but at times the price line moves above or below the earnings line depending on the mood of investors. Similar to 2021 when investors became too exuberant, the price again appears to have jumped too far ahead of expected earnings. We believe a pullback in the index price to a more normal valuation is inevitable. Another way to look at valuation is to see how much of the index is priced at a very high level. At the height of the tech bubble in the late 1990s, half of the market cap of the S&P 500 traded with a price-to-earnings ratio above 30 times. When investors became rational again, the percentage of the index trading above 30 times averaged only about 10% for nearly 20 years. Now we are back to 40% of the index market cap trading with a PE above 30. Optimism is evident in other surveys and positioning metrics as well. One of Conference Board's monthly questions for consumers is whether they expect stock prices to be higher or lower in 12 months. We are at a level previously hit in the tech bubble, the height of the housing bubble, and in 2018 before a significant decline in stocks. Professional investors are positioned in a similarly bullish way. The problem is their track record when they are this confident is poor. Early 2011, late 2019, and 2021 were all peaks in the stock market before declines of about 20% or more. Vanguard recently updated its forecasted returns for the next 10 years by asset class. It looks like the opposite of the last 10 years. Specifically, the best performing parts of the market during the last decade have the lowest projected returns when looking a decade ahead. The S&P 500 as the best broad measure of stocks is only expected to deliver a 4% annual return through 2034. There are other measures we have seen that have reached a similar conclusion, that stocks are only expected to deliver about a 3 to 5% annual return over the next 5 to 10 years. Here's another one. The spread between the yield for high yield or junk bonds and the yield of a U.S. Treasury note is now the smallest since 2007. When spreads between high yield bonds and treasuries are this small, the S&P 500 historically has delivered just a 3% annual return over the ensuing 5 years. The final example showing the optimism of the market incorporates the hopes and dreams of investors. This metric breaks down the S&P 500 into 3 components: the book value of the stocks in the index, the value of the expected earnings from these companies over the next 3 years, and then the rest is the hopes and dreams component for all the embedded value expected to be generated beyond 3 years into the future. What's notable is currently 2/3 of the value of the S&P 500 is in this hopes and dreams category. That's like only 2 other times in the past 35 years, the tech bubble and 2021 before the bear market we experienced in 2022. In summary, there are several metrics we track that suggest that the S&P 500 is only going to generate about a 3 to 5% annual return over the next 10 years. We think it's okay to have a base of capital invested in risk-free treasuries earning a 4 to 4.5% annual return, and then look for reasonably priced stocks that could generate a double-digit return over that 5+ year time horizon, rather than just sticking in an index that might be overpriced. If you have any questions or would like to learn more about Oxbow, please contact us. We provide the information that we think is most valuable to investors. If you'd like to follow our work more closely, please subscribe to our YouTube channel.